Hey, good morning, everyone. Marty Missouri here, 22nd of August 2019, Thursday. Your pre-market update. That's the S&P 500 futures chart, the one we've been checking in on every morning just to redraw my arrows. Remember, originally we were pointing to this steep but relatively shallow sell-off. I expected kind of your typical ABC waves. You down, you back test, find resistance, and you make it to lower lows. And I told you the more we move sideways and don't break below, and particularly the more we establish kind of an upward trend in here, the less likely it is that we break down below here versus breaking out above there. I've been saying it's about 50-50, but we've hit this area 1, 2, 3, 4, 5, 6, 7. Then again, remember yesterday morning, I said we were going to challenge that, and I said maybe yesterday was the day. Closed right on it. Here we are this morning, literally live futures right there. We have pierced it, and right now we're sitting literally right on that line. You sure would think today would be the day. Now, make no mistake, folks, as I've been pointing out, there has to be a raft of shorts sitting right here above that line. Folks who were making bets that this market was going to fall out of bed and they'd profit big time in the process. Well, they don't want to lose too much, so they're not going to allow this market to really run away from them to the upside without covering those shorts. And covering those shorts means buying them. In fact, I'm sure they have pre-programmed buy stops in here. That's going to bring a wave of buying into the market. And of course, what does buying do? It pushes stocks higher. So look for this morning, if we get an open much into this area, look for some impulsive buying to push this market up. Then we're going to be talking about resistance in other areas. Now, not that much higher. We have this line right in here, right about 2960. If I zoom out a little bit, you can see how important these lines are. So again, here's that 2960-ish line, and you can see how important that has been. So breakthrough here. And then make no mistake, I don't think in this environment that the pictures I've been painting for you in terms of, the fundamentals, geopolitical risk, systemic risk in the bond market, there are folks who are positioning to profit from a whale of a downturn. Make no doubt about it. You clients out there, we're just hedging against that with options, willing to give up this upside or a good chunk of the upside if this continues to melt higher to protect us against something that could be much worse. But right in here, folks, we're looking at positioning. We're looking at a lot of bears in here that look like they're going to get trapped this morning. Now, the other side of that is as the bulls come rushing in here and getting sucked in by the thrust upward, if indeed we do get that, of course, then we get sentiment way over on the other side of the boat. So this ultimately looks like, I like the term trap, looks like the shorts or the bears are getting trapped in here. Then ultimately what happens is you suck in a lot of unsuspecting bulls, you hit these other areas, and then you give up the ghost, and that's even worse. There's nothing worse than a failed bullish breakout, which is what we've had up in here. Ultimately, this is still playing itself out. But right now, clearly we have a market that wants to move higher. We have central banks the world over are doing nothing but talking about stimulus. Governments are talking about things like, here in the U.S., payroll tax cuts. Under the surface, we have other rhetoric that would be very concerning if it were happening 2 weeks ago. China said last night that they are absolutely going to retaliate if these tariffs go in place on September 1st and then December 15th. The list of tariffs has been set. Supposedly that's carved in stone. Of course, anything can change. But if indeed you get an announcement that China is retaliating either through additional tariffs, if they have room for that, or the halting of exporting rare earth materials to the U.S., that sort of thing. There's a number of things they can do. That's going to be pretty ugly for the market. And that's the kind of situation where you could suck the bulls in, get them trapped, and then have them all exit at the same time. And then my original notion that we go down through here, and test lower lows, will be something we'll be talking about. I still maintain that without a resolution to the trade war, and that means a rolling back of the existing tariffs, that we cannot avoid that scenario. I don't see how this market holds up against those headwinds if they continue to persist. Another thing I've been saying for a year now, and I'll stop here, is that we can't end the war with China and then take it to other parts of the world. In fact, there was I think it was a Wall Street Journal article last night that said that a trade war with the European Union would be even worse, and I think much worse than the trade war with China has been. So a lot to be resolved over the next few months to a year that really has serious market implications. All the while, the fundamentals under the surface are waning, as I've been illustrating for you here. So again, I think I should take every opportunity to remind clients why we are now hedging portfolios, giving up upside potential to protect against monster downside risk. As long as that potential is there, as long as that's my thesis, if you will, that's what I think we have to do to accommodate for what is a very dangerous risk-reward setup. And one last thing, I promise this is it. It's the right now, today, they're interviewing folks in Jackson Hole. It's a Jackson Hole, Wyoming symposium that the Fed does every year. Tomorrow, Jerome Powell speaks. I think some of this optimism here is the belief that he is more market friendly in this speech than he was at the last Fed meeting, and maybe suggests that that the Fed will be more aggressive with interest rates, that it wasn't just a mid-cycle adjustment or an insurance cut here the other day, that they're going to embark on a policy of more consistent easing. If he gives that message, I think we get the kind of move that we got back up in here in 2011. You can see the Friday of the speech and then the day after. Boy, between the two, that's about 3 or 4% move in the S&P 500. That's enormous. This just gives you the last Fed meetings from 2010. This was Friday. This was the following Monday. That was 2011. By the way, 2011, we were in the throes of the European debt crisis. That ultimately resolved in a 19.9% correction. So again, you tend to get these big, gigantic days during big corrections in big bear markets, and that was a big correction. And you can see from there in 2015, there was no Fed speech, and Monday after, it wasn't a big deal. 2018, what did we get? Yeah, almost a 3/4 plus another 1%, almost a 2% move last year in 2018. Remember how the last quarter of last year resolved. So we had a really good looking market right in here, right when the Fed was having this meeting. We were making money. There's the opening bell. We were making money, and we made money all the way up until early October, and then we fell out of bed that year for a 20% correction. So that's when you'll feel that nice, warm, cozy feeling, if we get that again this year, in your portfolio. Of course, it's not even that we're protecting against. We're protecting against something much worse than that. We're protecting against the possibility that under current macro conditions, that would precipitate the next recession and the next bear market. That's what we're protecting against. But if it's a replay of last year, we're really good between now and October, and then we fall out of bed thereafter. This won't be a replay of last year. Lightning doesn't strike twice, one year to the next. But this year, actually, the setup looks worse than it did this time last year. So I'll leave it there, folks. Much more to come. I'll keep you posted virtually on a daily basis. Thanks again. Take care. Bye-bye.